intermediate E&Ps, both in Canada and the U.S. For this 20-minute session, we'll have a discussion with two companies, Peyto Exploration and Spartan Delta. From Peyto, we have Jean-Paul Lachance, the company's Chief Operating Officer, and from Spartan, we'll hear from Fotis Kalantzis, the company's President and CEO. I'll start by asking each company to provide a brief overview, an update on their business, basically things that they want you to take away from this presentation, and then we'll move into some brief targeted Q&A. With that, I'll turn the mic over to JP. JP, could you give us a brief update on Peyto?
Sure. Thanks, Aaron, for the opportunity to speak about Peyto. We're one of the more active companies right now with 4 rigs operating. We recently ramped up from 3 to 4, but effectively been keeping our production flat since February with an average of 2 rigs running. We're more or less halfway through our planned 2020 capital program, which we've guided to 200 to 250 million with as many as 65 wells. We've steered our drilling program toward our leaner, gassier species, which still includes some Cardium, but a lot more Spirit River than last year for obvious reasons. We've seen some real improvements in overall cost structure. Most importantly, our efficiencies. Our drilling is down under $400 a meter, and our completion costs are down under $40,000 a stage. This is a testament to our small, efficient team, both in the office and our supply partners in the field, whom we've built long-lasting relationships. We're drilling longer horizontals with this program, particularly in the Wilrich, up to 2,500 meter laterals, and we're increasing our frac intensity, up to as much as 0.75 tons a meter from 0.5 where we typically have been. And we expect that'll translate into better outcomes and more efficient use of our capital. We have the flexibility with our 4 rigs to slow down by shutting them down for brief periods between pads, which frankly is happening right now, but not by choice, but by the wet weather out there. So we can moderate the capital spend in the back half, or we can choose to keep them all running at full out if we want to increase activity as better gas prices materialize for 2021. And we're quite bullish on 2021 for gas. We think that the low rig activity in both the U.S. and Canada will manifest in significant declines by year end and a significant shortfall in supply next year. So that thesis is presented in the latest monthly report you would have seen from Darren, his President's report. You can find that on our website. But it speaks to rig productivity and the need for a significant ramp up to arrest declines. So although we don't plan for that, if that happens, it'll give us a materially more cash flow for 2021, and we'll deploy that against debt or capital growth or dividend increase or some combination of the above. And just as a recap of our last press release, we recently reached an agreement with our lenders to provide relief on our financial covenants to allow us to get through a trough of low pricing and lower cash right now in the short term. This amendment comes with a reduction in our credit facility, but arguably that unused facility wasn't something we could use anyway, and of course we're paying for that. So at the end of Q1, Peyto has drawn roughly $700 million on our credit facility, leaving us ample room on the new $950 million line to execute our capital plans over the remainder of the term into the fall of 2022. So that's a brief update on things at Peyto. I'll turn it back to you, Aaron.
Perfect. Thanks, JP. Fotis, could we turn the mic over to you, and I'll ask you the same question. Can you just give us a brief overview of Spartan Delta, touch on any key themes that you think investors need to know walking away from this panel?
Yeah, Spartan Delta is a brand new company. We just started at the beginning of the year through a recapitalization of a small public entity. And then we start looking for acquisitions. The strategy is to build a mid-cap upstream company through targeted consolidation. Our goal is to be north of 100,000 barrels a day in the next 24 months. We seek quality assets that we can restructure, optimize them financially and operationally, and generate material free cash flow. We just acquired the Bellatrix assets. We closed that acquisition about 5 weeks ago. The Bellatrix assets fit that criteria that need to be restructured, optimized, and rebranded. It's one of the best set of assets in West Central Alberta that they needed additional capital. The asset base, of course, was burdened over the years with too much debt and a number of different take-or-pay commitments and contracts. Most of those have been cleaned up through the bankruptcy process and through Spartan direct negotiations with midstream companies. So we started 5 weeks ago with about 25,000 barrels a day. We raised $64 million this time around, plus 25 in the beginning of the year. And we have over $100 million of credit facility, so we're well capitalized to continue our acquisition strategy. So basically, we're a brand new company with no skeletons in the closet, clean operating platform, no legacy contracts, and 5 weeks in, after some optimization, we exit the month of June at 26,000 BOE a day. That was achieved with no additional capital. It was just low-hanging fruit optimization out in the field, integration activities. That shows also some of the best stuff that we retained through the transaction, and of course the predictable nature of this asset base. This asset base currently declines at about 19%. So we're very happy with that. Also, we inherited some good infrastructure. The net ownership for us is over $200 million, and we basically didn't pay for it. We paid $108 million for the whole transaction, so that infrastructure came, and it also, we have excess capacity that will allow us to both organically grow this asset and also to do strategic acquisitions in this fairway. In addition to this, in the last month, we, to protect both the future economics and the economics of and the metrics of this acquisition, we strategically hedged about 60% of our gas volumes for 2020 and about 45% of the gas volumes for 2021. In terms of activity in the field, we're just only 5 weeks in. We're currently looking at the budget for the rest of the year and into next year. We hope to move a drilling rig sometime in Q4 and start drilling some wells here. In the meantime, we're going to continue on the acquisition opportunities both in this fairway and elsewhere. That's kind of the update for now.
Perfect. Thanks, Fotis. Just a follow-up question to that update. Given the environment for both crude oil and natural gas today under a strip pricing scenario, where do you see the most opportunity and upside potential, either from an organic drilling program or from the perspective of strategic M&A?
I mean, for us, there are two fairway. One fairway for us is West Central Alberta, where now we have a significant footprint. We know Central Alberta. We built 2 Cardium companies here before, and now, of course, we have this asset base. So that's one of the areas. And another area that we like, of course, is Peace River Arch, where we have a small foothold in the Charlie Lake, and we like to look at both Charlie Lake and Montney opportunities up there.
And in terms of commodity type exposure, would you be more biased to crude type plays, given the Cardium and the Charlie Lake, or would you be looking for more gas-weighted assets?
For us, we like to have a balanced portfolio both on the oil and gas. With this first acquisition, of course, we are 70% gas and 30% liquids, only about 5% oil. But we like to be more balanced, but at the end of the day, we're opportunistic, and it's all about rate of return and the opportunity in front of us. So, yeah, we're going to look at both oil and gas.
Perfect. Thank you. If I could flip over to Peyto, JP, you talked about allocating incremental capital to more gas-weighted plays from sort of the more recent strategic direction to drill liquids-rich Cardium. How should we think about your decision to do that outside of economics? I know one of the strategic reasons to develop the Cardium was not only IRR, but also longer-term free cash flow sustainability of the business, because the Cardium had a lower, longer-term decline rate. How do you think about transitioning back to gas in context of your decline rate?
Yeah, I think we've seen a little bit of a shallowing in our decline rate for sure. I think that's as much to do with the program that we've drilled as much as it is the species. I'd point out that our richer liquid wells, our liquid-rich wells, they don't hunt. It's not that they don't hunt right now. It's just that we'd rather save those for a better oil price in the future. The Cardiums and the Spirits, they don't behave too much differently with respect to decline. When the Spirits gas trends, the gas will decline faster than, say, the Cardium. But the Cardium's initial production liquids come up quite a bit too. So then when you look at those two together on a BOE basis, they're not a whole lot different. So declines aren't really the major, decision in the portfolio selection. I think we've been very pleased with certain areas of our program right now, specifically Chambers, it's south of Braz. We've exceeded our expectations there. So the focus is as much about proving up certain areas, and some of the well completion changes that I mentioned there about longer laterals and greater frac intensity in the Wilrich, as it is about just drilling lower risk gas wells to be more efficiently. So I wouldn't say that our mix is necessarily driven solely by by the declines.
Okay, thanks for that. Maybe I'll stick with you, JP. In the past, Peyto's generated third-party processing revenue from its excess infrastructure capacity. Now, we're in a world where basin volumes are likely contracting again. Producers are staying flat or letting volumes erode a little bit. Is this becoming challenging to attract third parties to process same levels of volumes through your infrastructure, or how should we think about your unutilized infrastructure capacity?
Yeah, just as a reminder, we own 9 gas plants, an extensive pipeline network that connects to those. They have a combined processing capacity of about 850 million cubic feet a day of capacity, which we're only using about half right now. We deem the value of that, or we look at the replacement value of that is roughly around 1.4 billion. So it's a significant asset to us. Our focus has been on attracting third-party volumes in the area, in our areas. It's tough, as you point out, since there's not a lot of drilling going on in these areas, except for maybe ourselves. But on the flip side, that argument is the lack of drilling means that other plants in the area are declining, and so their unit operating costs are climbing. And sooner or later, our lower cost alternative makes more sense, and we can consolidate. So, I'd also like to think that we can compete head-to-head with any of the midstreamers in the areas as well with our fees. So, we have a few deals we're working on like this right now, and we hope to be able to talk to more of that maybe by before year end.
I'm sure you saw the advantage Topaz take-or-pay style midstream transaction that they did. Is that something that Peyto would look at to sort of enhance the value or the unrecognized value associated with the spare capacity?
Yeah, for sure. I mean, maybe, I guess I look at this as, although we've always held our low operating cost structure as as sacred as a sacred cow. If any company can burden our assets with a fee or a royalty, certainly it's us. So that's not off the table, that's for sure.
Perfect. I'm going to switch over to FOTUS. How does ARO and other environmental obligations factor into your sort of assessment of acquisition opportunities? And maybe a related question, how do you plan to manage your current liabilities?
ARO is very important to us. I mean, we're a new company and we want to stay relevant, and environment is in the forefront of the Canadian public and the Canadian investors right now, so we're going to pay attention to it. Luckily, with the first acquisition, our liabilities associated with our asset base right now are very manageable, very high LMR, and we require very limited spending on this current asset base. But going forward in future acquisitions, of course, that's something that we always pay attention, and we always evaluate. Actually, we evaluate it separately from the reserves that we look at to acquire, especially when it comes to inactive liabilities. And we definitely make sure that we factor it into the valuation and subtract a large chunk of that liability.
Okay. I don't know if you've had an opportunity to evaluate many assets since you've been live as Spartan Delta, but how much of a hurdle has ARO been in some of the options that are out there in the M&A market?
It does. I mean, some people believe that they should not get penalized, and like in the old days, people used to kind of kick the can down the road and pretend that didn't exist. But going forward, I think we need to pay attention to it, and some companies are willing to negotiate on that. Some are not. I think the banks are viewing it the same way that we view that. So at the end, we're the buyer, and we're going to buy it only if it makes sense for us.
Okay. Going back to JP, you mentioned in your opening remarks that you've had your covenants relaxed a couple times, and most recently it's given you quite a bit of leverage flexibility. Are you comfortable with your leverage profile today? Where would you like to see your leverage move to under a strip pricing scenario? And maybe a related question is there a point where the dividend starts to creep back up? And when would that be, and is it tied to like a debt to cash flow metric?
Yeah,
breaking news overnight. The Daily
with our continued improvement in efficiencies, and lower declines, we expect that the cost to replace production, will be a lot lower in 21 and 22. So I think we, estimate around 180 million for next year, and as low as 165 million the year after. So that'll generate free cash flow. So under the current strip pricing, and allow for growth or debt repayment and or maybe a dividend increase to shareholders or some combination of that. That's certainly a possibility. We don't have a specific target in place for any of this. We review the dividends on a quarterly basis, so that'll, with our board, and that'll be part of the discussion, no doubt. But we don't really have any specific targets in that regard as far as a certain debt to, or a debt to EBITDA sort of marker. That I think the key for us is to generate that free cash flow and pay down debt or grow the program and move from there.
Okay. Just a comment or a question from an investor through the webcast. As part of the covenant renegotiation process, were there any restrictions on capital being used for dividend purposes?
There are some restrictions, but nothing that we couldn't work out with the banks should there be any a need to, if they're on side. I mean, obviously for us to want to increase our dividend, it would be something that we see that makes sense going forward, and so it could be arranged. So there are some restrictions with respect to a few items that, again, provided we're seeing the cash flow and the free cash flow, those things can be managed. So.
Perfect. Well, that's our entire 20-minute slot. I realized the time was short and we didn't dive too deeply into each of the companies, but for those of you